This program was first broadcast on Canterbury's access media station, Plains FM, and was made with the assistance of New Zealand On Air.
Welcome to your weekly dose of the Accountology Show. I'm your host and chartered accountant, Nicole Haig, with an insatiable curiosity for uncovering accounting ideas to help businesses grow. I have so many nuggets of gold to share. Are you ready to make your good business great? Let's get stuck right in. Hey, it's your host Nicole Haig and welcome to another exciting episode of the Accountology Show. In today's show, we're going to have a wee conversation around cash flow or profit. But before we do that...
Oh, it's Alex here again.
Yeah.
I just thought maybe I should just reintroduce myself.
For those listeners that have just joined in.
That's right. I started, actually I had an interview with you, Nicole, on the show as a business owner, and I just thought you looked a bit lonely doing this.
I do need some more company.
So Nicole and I got talking and we just thought, oh, why doesn't she have a sidekick? And that sidekick can be me because I'm a curious little being.
I think it's great to have someone to ask some of those questions that I might just assume everyone knows.
Yeah.
So it's great to be pulled up on some of those.
Well, I mean, my friends think it's hilarious that I'm on an accounting show.
A creative
is on an accounting show. But I'd say I'm here for...
the greater good.
The greater good, to ask the silly questions. And it turns out they're not that silly.
They're not silly.
Sometimes.
No,
sometimes.
Because if you're thinking it, everyone
people,
else is out there too.
Yeah, so I just thought I'd remind everyone who I am, So I'm an interior designer, but yeah, like I said, I've run my business for 18 years. I'm no expert, but I'm interested. Yes. I'm curious.
I think curious. I love that word, curious.
Yeah, it's a superpower of mine.
I love it. Are you a business owner struggling with profit, cash flow, or to find balance between work and life? At Nicole Haig & Associates, we want to help business owners just like you reclaim your freedom. Freedom to spend quality time with loved ones, freedom from stress, and freedom from financial burdens. But how do we do it? It's simple. We listen, we understand, and we create bespoke, structured programs tailored to your unique business and personal goals. With the right education, coaching, and expert advice, we'll show you how to increase profits, improve cash flow, and align your business and personal goals. Don't do it alone. Let NH plus A be your guide to success. Work smarter, not harder, with our proven accountability methods. Your freedom starts here. Contact us today. Okay, so let's talk today about the difference between cash flow and profit. And I know we've done an episode on this before in a little bit more detail, but let's get down to the nitty gritty and talk about, what it is, what the difference is, because as I've mentioned before, numerous times I'll have clients in the office and we'll be going through their annual accounts. We'll be talking about tax and how much they've got to pay. And they'll go, but I don't have that much money in my bank account. So how do I have to pay that much tax?
Right. So that would be cash flow.
Yeah, exactly.
Yeah.
So the difference is, in a nutshell, like profit is having a look at what your sales are, less your expenses.
Over a period of time?
Yeah, over a period of time.
Right.
So it could be a financial year, which could be in New Zealand, the majority is the 1st of April to the 31st of March.
Right.
Or if you're a farmer, it ends the 30th of June. And some have odd balance dates like 31st December, for instance, like a calendar year.
Right.
But majority in New Zealand is March balance date.
So majority of businesses, what would be a business that wouldn't have that? Well, apart from farming.
Apart from farming. Some of them want to align with the calendar year. So you might be seasonal and for whatever reason want that to align with the calendar year. So you can choose. There's no set rule that you actually have to have a balance date at the 31st of March.
Right.
But everything in New Zealand is generally the financial year.
And there's leeway with that too, because if you do your accounts roughly about then, but you've got time to do them further down the track. Or,
correct.
Yeah.
So if you're with an accountant or a tax agent, you get, because an accountant can't get everyone, technically you're meant to get it done by June. So your balance date's March, but then you've June have to have everything filed.
Right.
An accountant can't get all of that done in a couple of months for all of their clients.
Yes,
so
I understand.
we get to an extension of time, EOT, until the 31st of March the following year to get it all filed. And then there are if, buts and maybes along the way, that you can get further exemptions. But in essence, you've sort of got 12 months to get it filed.
Oh, that makes sense.
But it is good to know. You probably don't want to leave it that late, and because you do want to know what your profit's looking like for the financial year. If you haven't already, if something majorly's gone wrong and you haven't been tracking it throughout the year, then you want to keep an eye on,
Well, it's like an enforced audit.
Yeah, exactly.
Yeah.
Exactly. So, well, we'll say to a client, okay, you've got this amount of tax to pay. And they say, yeah, we don't have that in the bank account. How can it possibly be? So for a lot of business owners, it's understanding the difference between the two, because there is a difference.
What would they say? But I've been making a profit, so why haven't I got money in there? And,
Yes.
And the money in there is the cash flow side of things.
Correct. And that's a really good point, Alex, because you can make a profit and have no money in the bank and have no cash flow.
Yeah.
Or
Why would that be?
Okay. Yeah.
Or should I come back to that one?
No, hold on. Yeah. No, this is good, because we'll explain that. Or you could be making no profit and have money in the bank.
And have cash flow.
Yes, and have cash flow.
Okay.
Now, the reason being is that because you could be, let's just say you're not making a profit at all, but you've got money in the bank because maybe you keep putting money back into the business to keep it afloat. That could be a reason. Or you're getting a loan or a mortgage or whatever.
And you're repaying that back.
Yes.
Or is that something different?
Yeah, well, no, yeah, yes. Okay, so we'll come back to that, because let's go back to the difference between cash flow and profit.
Yep.
So, okay, as we've determined, profit is your sales or your revenue or your turnover less your expenses, and ultimately it's your tax deductible expenses. So there could be some things in there that don't go through your bank account. So yes, your sause go through your bank account.
Yes.
Majority of your expenses will go through your bank account.
What wouldn't go through your bank account?
Depreciation.
Oh, because on capital items.
Yes. So depreciation is deductible for tax purposes. So it comes off your profit, but it's just a journal entry. It's a paper entry. It doesn't go into your bank account. So that's the difference as well. Just be aware that if you had an item, and this quite often happens with motor vehicles, your business might own a motor vehicle and it gets deducted year after year, with depreciation, and that depreciation you get to claim as a tax deductible expense and comes off your profit, off your bottom line.
Yeah.
But then all of a sudden you sell your vehicle because you want to upgrade, get a new vehicle. It's costing you a lot for repairs and maintenance, etc. So you sell it, but you actually sell it for more than the book value.
Yeah, so what happens to the difference?
Yeah, so you've actually made a capital gain on it.
Right.
But you've also got depreciation recovered. So any depreciation out of that capital gain, any depreciation you've previously claimed gets paid back.
Oh, I was going to say, is that...
Yeah. So, and what that's included is it could be depreciation recovered or gain on sale of an asset in your...
But it's quite hard to get your head around, like it doesn't go through your bank.
No.
It's not physical cash.
No.
It's just an entry in the ledger.
Correct.
But you've still got to pay it back.
Yes, if you end up, because how the IRD see it is we've allowed you to make, because the IRD...
We as in the IRD.
Yes, we as in the IRD, will allow you to make a deduction. So for a capital item, if you go out and buy a vehicle, for instance, you can't write off the entire, let's just say it was a $10,000 car. You can't write off that $10,000 as a deductible expense in the year that you purchased it. The IRD say you can write off a portion of that each year.
Right.
Just to account for the fact that it's going to decrease in value, you've got running costs, wear and tear, etc. So by the time you actually go to sell it, it will be worth less. So that's what the IRD is saying. But, so you get to claim that as a deduction. But then at the end, when you go to sell it, if you sell it for more than what, and quite often...
So if you sold it for $8,000...
Yeah, but the book value was, by that stage, $5,000. You've got a $3,000 profit, technically.
Yes.
Anything that you've claimed as depreciation has to be repaid.
Profit.
Yeah, because the IRD are kind of saying, well, it's almost like a loan from the IRD, even though it's not cash, but they've allowed you to make this deduction.
Yeah.
And now, actually, you didn't need as much of a deduction as we thought you would because you actually sold the car for more.
It's quite something to get your head around.
Yeah,
it's quite confusing.
Yes.
But that would be... that would be the job, your accountant's job, is to kind of know that capital items like a car or I don't know, a printing machine or
anything over $1,000. So there's a low value asset guide of $1,000. So it means anything that
Is
you
it a
buy.
percentage?
No, it's actually a dollar value. I know
It's getting technical.
So if you buy anything that is an asset for the business that you need in the business to run it, like you said, like a printer, a cell phone, or computer, car, plant and machinery, anything like that, or you do a fit out for your retail store or whatever, anything $1,000 plus GST and under, you can write off the whole amount that year. And you might see in your accounts by your accountant a line called low value assets.
So write off, that's a term that I've written down because, like people sort of casually throw that into a conversation. Oh, just write it off through the business. Yes. And like I'm still confused by that term.
So what it means is that you get to take the full amount and take it as a deduction. So it goes in as an expense against the sales that you've got in. So it reduces your profit.
Right.
So that's why I'm saying anything under $1,000 you can do that with. You can just put it straight into your profit and loss. And say you bought a printer for $900, right?
Plus just,
yeah. That means you could code it straight into your profit and loss to office equipment, for instance. And you get that whole $900, can write it off. It was going to reduce your profit. If it was over $1,000, so you paid $2,000 for a printer, then you can't do that. You would need to then add it into your depreciation schedule, your fixed asset schedule, and then write it off according to whatever the IRD prescribed the rates to be. So, like for instance,
and that's something an accountant will know.
Yes, but you can also find it out on the IRD website what their rates are. And Xero is actually quite good at being able to do those calculations for the depreciation as well. So then it flows through, but you still need to know, obviously, the information that you're putting in is correct.
Yeah.
So that's kind of what a write-off is. It's being able to deduct the full amount.
People sort of make it out like it doesn't cost you anything. Well, it doesn't cost you, but it does cost you a business still. Like you still have to, if someone says, you just write it off to the business, say a conference or something, the business still has to pay for it.
Correct. Yep.
It just means that you'll get the tax back on that.
Yes. So there's actually 2 points to that. So there's a flip side of that. So the positive is, and what most people are trying to say is, that's going to decrease your profit and therefore you'll have less tax to pay. Bingo.
Oh, okay.
People are saying,
reduces profit, less tax to pay.
But if you're looking at selling your business and you're putting all of these little things through that maybe aren't necessary, then you're probably wanting, your books to look better.
Yeah, you want healthier profits.
Yeah, so unless it's a legitimate business expense, which it should be anyway, then you shouldn't be putting it through.
Okay. Sort of makes sense.
Yeah. Okay. So we've got the profit and loss, we've got your sales, and then we've got all the expenses.
Yep.
That include things like accounting fees, bank fees, any asset items that are less than $1,000. You might have some repairs and maintenance. You might have motor vehicle running costs. You've got your wages.
Is there any other? So capital gets a
depreciation.
Depreciation. Is there anything else that gets an allowance like that? No,
mainly, except for like we just talked about the $1,000 for the low value threshold for.
Is it just for a physical item, or can it be for consulting fees or?
Yeah, no, you can put consulting fees. So if you've got somebody that's coming in, helping you mentor in your business,
and you're paying them.
Yes, and you're paying them, then that is a deduction.
But it's not a capital item.
No, because you don't own that. You don't own the person.
And that might be over $1,000, but it's something that you can't.
Correct.
Yeah.
So the difference being, so we call that expense it or capitalise it. So expense is when we put it straight through the profit and loss.
Yeah.
Capitalise is when we put it into the fixed asset schedule and write it off, a bit at a time each year.
Yeah.
The reason you'd put it into the fixed asset schedule is because it is an asset and it is something tangible and you own it. So at the end of the day, if you needed to sell it and get some cash flow, and you could, whereas consultancy fees are more like a wages.
Yeah. What about if you did sell the business So you're saying you own it, but the business owns it. Yeah. So they wouldn't be buying it at say if it was the car, the $10,000 car, they wouldn't buy the car through the business at $10,000. They would buy the car $10,000 minus the deductions.
Okay, so now we're getting into a little bit more complex situation.
I'm so sorry.
No, that's right. Because what happens there is there's different ways that you can sell a business, and if you were looking at one of the ways that it included you would sell the assets with it, then that's also another area that you would negotiate the price on, because...
Would that be like chattels in a home?
Yeah, kind of like that. Okay. Exactly.
Well, that makes sense.
Okay, so that's profit.
Okay.
And then that's what you're taxed on. Long-winded way, but that's what you're taxed on.
Okay.
Cash flow, on the other hand, is anything that goes through your bank account. So, yes, all the sales from your profit and loss are going through your bank account. All the expenses like your ACC, wages, office expenses, all of that kind of stuff is coming out of your bank account. Direct costs such as freight, manufacturing costs, etc., materials, all comes out of the bank account. Depreciation does not come out of your bank account. So there's your first difference.
Well, depreciation isn't a physical dollar. It's
correct. It's just a journal entry.
Yeah.
Yeah.
Gotcha.
Yeah.
Okay. Well, that makes sense.
But other things come out of your bank account that don't come out of your profit and loss. So if
interest?
Okay, great one. Okay. So we've got a loan. You've got a loan.
Yeah.
For your business. When the loan money comes in, whether it's from a bank or financier or whomever, then that goes straight to your balance sheet and it goes through your bank account.
Does that go to the cash flow?
Yes. Yep. So that's cash flow. There's money coming in.
Yeah, it's not money you've made.
It's not money you've made, so it doesn't go into your profit and loss. It helps finance the business. But then you make principal repayments, so you start to repay that loan off. That does not go through your profit and loss.
The principal.
But the interest does. The interest is a tax-deductible expense.
Hang on. Just remind me.
Yep. So if we think about your mortgage...
Principal is the money that you've borrowed, and interest is on top of the money that you borrowed.
Correct. Yep. So let's equate it to a mortgage on your home, right? So you go and it's the same in business. You've got a loan for $100,000 and the loan might be over 10 years.
Yep.
And the interest rate is, let's say, 5%. So when you start to make principal repayments, you're actually trying to pay the $100,000 off.
Yes.
That goes through your bank account, but it doesn't hit your profit and loss.
Because it's already
because the money came.
Hang on. Can you hear my brain ticking over?
I was letting you process it.
Yeah. I'm doing the fingers of processing. Okay, carry on.
Okay, so shall I repeat that?
Yeah, repeat that.
Okay, so you've got a $100,000 mortgage on your house, right?
Yeah.
In this case, it's on your business. And then you make repayments. Say you're paying $10,000 a month.
Yep.
I know it's a lot, but let's just say $10,000 a month. So that $10,000 comes out of your bank account, but it doesn't affect your profit at all because it's been used to finance the business. It hasn't been used to generate your sales.
It hasn't come from sales.
Yeah, it hasn't come from sales or
payment.
Correct.
Yeah, gotcha. Okay.
But there's also an interest component on that mortgage.
There is.
So that's for you to have the use of the money. That's their profit essentially. So you are paying 5%, let's say, interest. Now that interest is a deductible expense.
Yes, because that's over and above.
Correct. So the interest comes out of your bank account, so it affects cash flow, and it also affects your profit. It decreases your profit.
Yes.
But the principal doesn't. It only comes out of your bank account.
That makes sense. Okay, clear as...
Mud.
No, clear as clear thing.
Okay, good. Crystal clear.
Crystal clear.
Okay, then you've got GST.
Yes.
You pay GST. That doesn't affect your profit and loss because actually your accountant will be presenting your accounts to you GST exclusive.
Yes.
So the figures that you've got in there are already GST's been stripped out of. It's when you pay your GST, that comes out of your bank account, but it doesn't affect your profit and loss.
Okay.
Income tax or terminal tax or provisional tax or any
I feel
type.
like we're on a monopoly board. Yeah.
That, again, comes out of your bank account.
Income tax.
Yeah.
So that is anything that you made a profit?
Yes. Yeah, so your profit Then it's treated as income from the IRD's perspective, and then they tax you at whatever, if it was a company profit, then it's at 28%, for instance.
Right. Okay.
And then that, so if it's provisional tax.
Okay. Remind me.
Okay, yeah, sorry. Okay, so income tax is made up of provisional tax and terminal tax, and provisional tax is paying your tax in advance. It's almost like crystal ball gazing and trying to work out how much profit am I going to make this year and how much tax
Who works that out? Your accountant?
Yes.
You've got a lot to do.
Well, there's two ways to calculate it. Some accountants just use last year's figures, so whatever your profit was last year, and then add 5% on. And that's called the standard, and that's what the IRD quite often use as well. So,
and I know that I've got an account that I put money into for my provisional tax.
Yes, so you'll be putting...
So I'm also guessing what it will be based on last year.
Yes.
So it's two guesses. Accounting's guessing, I'm guessing.
Yes.
Okay.
Yep. But we also, for our clients, we sit down and calculate how they are actually tracking to date, because remember, provisional tax is paid 3 times a year.
Yes. So when you go to work out the provisional tax, you're not guessing?
No, we're not guessing.
Okay.
So we are using a calculation of saying, well, this is how much profit you've made so far. Let's annualise that, assuming that you're going to keep trading the way that you are. And then
annualise or annualise?
Sorry, yes, it could, yeah.
Annualise.
Annualise, so make it annual, make it...
Okay, not analyse.
No, annual, to make it look like an annual figure.
Gotcha.
Yeah, that was good because it wasn't very clear, was it?
Well, no, I just had to make sure because, it could have worked both ways.
Yeah. And then we'll say, okay, you've got this much provisional tax to pay. Now, that comes out of your bank account.
Yes.
But that at that point doesn't affect your profit.
Okay.
At that point.
So we probably got off topic again, but, the original question, which is more important? Should I take a guess? Which is more important, cash flow or profit?
Yeah, good question.
Well, that was the question.
Oh, you want me to answer that?
No. I'm going to have a go. Should I?
Yeah.
Okay. Well, I think cash flow is more important.
Cash is king. So
cash is king. So, because profit can't necessarily pay the wages.
Yes. Yeah, exactly. So you might have only a small amount of revenue coming in, but you've got a large amount of expenses, and therefore you're making a loss.
Yes.
And therefore it's draining your cash flow in your bank account, but then you go, actually, I haven't got much in the bank account, I better top it up. And from your personal finances, put in some money, and then so cash flow's okay. It looks like it's all right now because now you've got money sitting in the bank.
I know you use the word positive cash flow, so that's obviously...
Yeah, like money in the bank. So negative?
Because I know that it's obviously important to make a profit, and profits you can reinvest in the company.
Correct.
And pay yourself and pay your shareholders or whatever. But how do you balance that enough so that you've got dollars to actually run your business?
Yeah. So when you've got a profit at year end, you might have a look at it and go, okay, yeah, we've got a profit left over. How much of that are we going to use to pay a shareholder's salary?
Yeah.
And how much of that do we want to leave in the business to then use to reinvest?
Right.
So that reinvesting in other assets. So it could be you've got plant and machinery, but it's getting old, but we'd really like to upgrade that, which will help us then make more sales and more money. So we would like to leave that money in the business and then reinvest it and keep that circle.
Yeah, so we want the positive cash flow because that's the electricity that powers your business.
Yes.
And accountants really help with that.
Yeah.
I'm guessing.
Yeah. So if we get a client that rings and says, oh, can you please prepare us a cash flow forecast because the bank has asked for it? Great, no problem, we can do that. However, we need to ask the question, what's actually at the core? Why is it that you're needing additional?
Yes.
There might be an underlying problem and you might be just putting a Band-Aid on it. So it'd be good to have the conversation around, okay, yeah, that's fine. And it might be great that you get some funding in, but what's actually going on in the business? Is there something?
I guess if you know that, you've got financial literacy.
Yeah. And then, and then there might be a few levers in the business that you can pull or change. And
and like anything, it's when everything's clear and laid out in front of you, and you've got eyes on your profit, eyes on cash flow, you're going to be able to make decisions better. You're going to have to, you'd be more savvy in the decisions you're making, and you can make decisions about where you're going.
Correct. Because it could be that drawings goes through your bank account, but it doesn't affect your profit and loss. Equally, if you're putting money into the business, it affects your cash flow, so it will increase it, but it doesn't affect your profit and loss. So to understand that and to understand what the differences are, to understand that you're having a look at your profit, but you're also having a look at your cash flow in the business as well, to make sure it can survive. Because you can have a business, like I said at the beginning, that is making a profit but is cash poor.
Yes.
And therefore it could topple over.
Yes.
Or you could have a business that's not making any profit, but then you keep putting money in from somewhere.
Yeah.
And you keep feeding it, so it just keeps going.
Got cash
so it's
flow.
fine.
Yeah.
So it's fine. Yeah.
Yeah. Okay. Well, that's really good, I think. I think that's, but I guess like anything, if you've got further questions, you're kind of a good person to go to clarify about a bit more about cash flow.
Yeah, and I think that if you are needing some additional financial assistance, whether you're looking at going through a bank or somebody else, that understanding the core reason why you're needing it is valuable information as well, because receiving a lump sum of money to keep the business afloat is just a Band-Aid.
Yes. Well, it makes sense now that we've kind of broken down
what the difference is between cash flow and profit.
Yeah.
So I guess that, cash flow, it keeps you operational. It keeps you able to meet your financial obligations as they fall due. Like we said, if you need to invest in your business and there's any expansion, scale up. And we're wanting it to be a sustainable, scalable and saleable business.
Nifty.
Yeah. So understanding net profit and cash flow are two critical elements before you even get into anything else. So I think for any business owner, is really important to understand the difference between the two.
I feel like I do now. Thank you.
Good. Do you think we've navigated the way through the maze of...
Really good, apart from the sidetracking. But I think those are all important things to consider, because as you talk about these things, other things come up.
Yeah,
and that's
exactly.
the whole point, right?
Exactly.
Great, thanks, Nicole.
Fabulous. Right. Okay, well, that winds up today's episode of a cash flow versus profit. But if you've got any questions on any of those
Don't
items...
ask me.
DM us.
Yeah.
And one of us will answer.
Yeah. I might give you some interior design advice, but...
And make it look pretty.
Yeah, that's right.
Yeah. Okay. Have a great day, everyone. We'll talk soon.
Thank you.
Bye. Thanks for joining us on the Accountology Show. If you have enjoyed today's show, you're in luck, because we'll be back next week. You'll find past episodes at plainsfm.org.nz and subscribe on Apple Podcasts or Spotify to never miss an episode. We would love it if you would leave a 5-star review and tell a friend or business owner who would benefit from hearing our show. We also love hearing from you, so reach out with any comments or a topic you'd like covered, and even suggestions for whom we should get in the studio next for an interview. You can find us on Facebook, Instagram, LinkedIn and TikTok. Our handle is NH Plus Associates, that's NHPLUS Associates, or email me, nicole@nh-a.co.nz. But most importantly, thank you for taking the time to listen to the show. Until next time, keep building that business into the empire it absolutely deserves to be.